All right, so DayTrader Rockstar here with you. A very special webinar. Uh, Doing it live, but recording it for future use. So I'll be presenting this weekend, or actually next. I think it's on Tuesday. You have to double check. The New York Traders Expo, put on by the Money Show, is this next week. Starts Sunday, Monday, Tuesday, and it'll be down in New York City. We've been going to this thing for like the last 8 years. So we have a booth down there, and I'll be doing a presentation. We'll be doing a speech. I have a couple interviews. Really, they have rolled out the red carpet this year, I see. And we're going to have our booth, and we always welcome all the members to come down. We have our member get together. So if you're a member of Day Trading Radio, stop by the booth. And but for the presentation, like I do every day, I believe in one really good style of trading, a very strict and tight criteria, a business model that works so well, trading off of certain setups. So basically, we're going to go over that. I want to go over that right now. We'll be discussing this at the trade show. Just did a nice video before on this, even a really good one, which I was just identifying all the setups in the market. And that was such a good one. Maybe I'll just put a link to the bottom of this video. Make sure you watch that one first, because that is a fantastic video. We just did it. So, just a little bit about me. Started trading full time in 1996. I can't even read it. Started Day Trading Radio in 2007. And again, we broadcast the markets live every single day. I don't think I ever take it. Well, we do take a day off every so often, but not too much. We got breaking news right now. American journalist detained in Venezuela has been released, the mother says. All right, that's not that breaking. So let's talk about it. This might be kind of a repeat of what we just were talking about, but what I talk about every day is something that's so important, and I'm so passionate about it. And there's just a one simple solution to this market. It's having enough patience and discipline to wait for these certain setups and then execute them with a certain criteria for your stop and profit, and everything works out. This is a business, and it's great to have that kind of being that organized and knowing that everything is working in your favor. And being in control of your destiny, basically. The patience part of it is one of the most important parts of it. So let's start off here. Let me. So I put together this little webinar, and it just talks about the methodology and developing, and what basically this is about is developing a business plan around a couple different setups in the market that are very high probability of have high probability of success. So it's called the HPS methodology, but it also it really tightens up everything. I think this is the key to making money in the markets. This is truly the key. The key is not having, well, I just got distracted because I'm reading Lottie Dottie's message in here. She likes the Blue Ridge Mountains. I'm going to the Blue Ridge Mountains this summer, actually. Sorry, this is in the video now. Lottie Dottie's immortalized. So when we break down everything, we want to establish everything in such a good system, a method. And this is kind of an outline of that method. And you could, again, apply it to your own, or just take some of the ideas and use them. But I try to touch on everything that's involved in the methodology to be successful in trading. And I think that's the key area, is to confine yourself. And it's hard for me to say to confine, because I'm a big Bruce Lee fan. Is to do not confine yourself to any set system or get yourself locked into any set way. Be like water, right? But in this case, we have to watch out for our emotions. Our emotions are more stronger than discipline. And things like that need to be in check, and this is one way that I put them in check. So I've kind of always write it out and push it here. This is the most consistent money-making trades. I know which ones they are: the divergence, long and short, 1 minute, 3 minute, 5 minute, 60 minute daily time frames. Everything's the daily, different time frames. Triple stochastic flag setups. You see me go over them all the time. We went over one yesterday. It was awesome. It kept people out of trouble. It could use for different things, but the same thing. Number 2, 200 EMA breakdown channel line bounce and oversold stochastic channel line bounce. Both of these are support lines, always buying into that pullback, but buying into the support. And the underlying denominator of all of these, it should be a quality name. You shouldn't be trading something that doesn't have that normal pattern or rhythm to it. You're not going to say, "Oh, this one broke down," but it's a stock that never trades. Anyway, let's move on here. Disclaimer. It's very important. You can barely see it. It's all dark because everything has a disclaimer. I apologize if I say something rude on this video, but this is my disclaimer. I'm allowed to do it now. It's all a crock. Disclaimer, you can lose your money in trading. Nothing's guaranteed. All right? Trading is hard because we think too much. This is my own disclaimer. If we have any chance of success, you must constantly apply and follow the set of rules that I want to show you. With this, this will eliminate the opportunity to think too much. All right, you get that, you understand it. Well, I don't know why this is so dark, but Pixie, I'm coming to Reno now. I know that you're giving out chocolate like that. I was just thinking about it. I was gonna message you. Now you're on the video. What are my goals? Can you even read it? They're so dark. I don't know why this is dark like this. It has something to do with a video. I hate goals. I like goals because I said, all right, I want to take this trade. I'm going to get $100. I'm going to move on. What if I get to $95 and I'll hold on? Then it goes to $75. And then I'm like, oh, I need that $95 back. I don't want it. That's not the right way of doing it. The indicators, the methodology should teach you how to get out and how to recognize weakness and just take it off. The majority of the time, you're going to be in a profitable trade. Really, you're going to be in a profitable trade the majority of the time. It's your job not to set goals, but to take it off when the time is right. So, goals are set up for failure. So with that said, making money means nothing if you don't stay healthy, exercise, etc. Your body, and I think that's super important. Your health becomes the most important thing in the job. If you're sitting there, you have all that time to sit around and trade, and you have enough energy to get up and just do some push-ups, man. It's so hard, but it's so good for you to keep that money, the blood flowing, heart rate going good. I'm sure hundreds of people, thousands of people come through day trading radio. Someone has gotten a blood clot from sitting down too much. It just happens after time. So you have to prepare. You have to you have to take care of it. To be healthy. You can't do anything if you're not healthy. Your mental state won't be good. Physical state, again, is important. To have your mental state is there, and it all comes together. Being depressed is tough to trade. And exercise could help all that. It's not going to cure it. I'm not saying that I have the cure to everything, but it's not going to hurt it. That's for sure. And believe me, we've all been through, probably something in our lives that we didn't think we were going to get through, and we got through it. Try to keep that attitude too. 23 years of trading, I know where there is no short things in trading, but also realized I found that there is areas in the market that have come to identify as HPS zones. These areas give me an accurate entry and larger than average move in the direction of the signal generated. These are the trades I only want to take. These are specific setups, and they are my product. Each setup has a strict criteria for entry and exit, along with a risk management zone, which is a stop. That makes sense? It makes sense. Everything here is based off of, you have to define yourself. The best way to define yourself is to write it down. It's on paper, it's in concrete, it's whatever. So I kind of put out a basic outline of what I want to watch for. My stochastics are my main indicator, so I'm always looking for that relationship between stochastics and price lines, stochastics and moving averages, stochastics, and if there's a pattern playing out. Wedges, channels, 1, 2, 3 patterns, flags, and pennants. Support and resistance lines. Defined as previous levels of contact that have been held in recent history on the chart. Wildcard, reversal candles, or any other special patterns we pay attention to. All these things are important. The more they line up, the bigger the percentage of the the move you're going to get in the direction of that lineup, meaning buy or sell. All these also can be used as a sell signal or a buy signal. You just have to reverse the the criteria, basically. The divergence is our go-to setup. I've just proven it to you, right? I just showed you that. Or the weak link in the divergence trade is ourselves. We don't have the ability to take every single trade for whatever reason. All right, mentally, some of us do, but we're all different. Maybe it's me. Maybe it's my personality that's holding me back, and I feel like I have to be a perfectionist in it, and I'm missing opportunities. Well, whatever. It still needs to be taught. You need to know what a divergence is to be successful. So this is basically what a divergence is, and it's when that price, that chart, that candlesticks, and I'm going to switch back over. I'll give you an example. When we're making this move down, we have a first low, and I always call this two-stage divergence. 2 stages to a divergence. The first low and the second low. When the first low hits, the stochastics will be oversold. When the second low hits, stochastics are going to be above the first low stochastic level. That is the divergence. That is your signal. That's it. I've adjusted mine to a level where I'll find that the divergences that have a steeper, lower trend on a steeper trend on the stochastics. Like I said, I want to show you this. Let me see if I can go to this other screen here. Back here, this is a pretty steep divergence, a running divergence too, where we have a low and a low, but a much higher low on the stochastics, way above that channel line. It's a big space between that. This line here between these lows, this low and this low, is very steep versus a shallower divergence, which might be down here and harder to read. So the easier the divergence to read, the more chance that you're going to get that move. All right, so that's what that is represents. So there's different type of divergences. We have the bearish divergence. It's the opposite. We have the price making a higher high, but the stochastics making a lower high. This is great for newer traders and not familiar with who developed the stochastic indicator. Just 1950s, George Lane, mathematician, stock guy, developed this, and not to misquote him, he got the formula. I think a bunch of Portuguese or Polish workers that they measured cement with. Now, I would love if this guy was alive to interview him and understand the concept of how he could pull off a stochastic indicator from a formula for construction. I don't know how he did that, and I haven't found out that. But there is a famous quote of his which kind of breaks down what the stochastics represent, and it's the power, it's the momentum behind a stock move. So your candlesticks is the rocket. The candlesticks are the rocket. You can't see the power under the candlesticks. That's the formula that's being placed. And when that formula starts to turn down, you sometimes can't see it on the chart, but you can see it on the stochastics. So the stochastics, what it's saying is the price moves up, the stochastics are moving up. Stochastics is the power. When you launch a rocket, the rocket is shooting up in the air until the power runs out. But when the power runs out, you could measure that, and the power dies. It dies and turns over. But the momentum of the rocket will continue to push that rocket higher, a little bit higher before it rolls over. So that gives you a clue. When you see the divergence or the stochastics start to roll over, you know the internals are rolling over, even though the price is still pushing higher. And that gives you a great advantage in the markets because you're able to buy, short or buy into weakness or short into strength. Either way, this is an example of a short right here. If you think about this being the stochastic, this being the price. Fantastic analogy by George Lane. It must slow down, momentum must change direction before the price changes direction. And then again, going back to these charts back here, there's nothing here that has failed when I show you that thing. Now, I'm not going to go into the divergence formula. It's easy enough to look up and calculate it. But the divergence oscillator, or the stochastics, let me see if I have a little stochastic. Well, here's the more on the divergence here. Let's see if I can back that up a second here. The stochastics are your indicator that you're measuring the divergence with. And now there's a formula. Put in price, level, whatever the formula calls for, closing price, whatever. Put everything in it, and it'll plot a point. And that point will be between 0 and 100. And that's basically the plot that you're seeing on the stochastics. So the stochastics are plotting between 0 and 100. The representation of this number is the level on the candlestick where the price is closing, or at that instant. So the closing price in relationship to the total price of that candle over time, it's being all right, now all of a sudden we see the price closing lower over the candle. Now it's kind of sometimes a harder concept to just explain without showing examples, but believe me, you have to do a little bit more research on it, get it down. I just want to kind of run through this pretty fast. I don't want to go into detail as much on how to break down all the formulas and stuff, but I'm trying to explain as much as I can that stochastic really measures the price level of those candles compared to the previous price levels. So your stochastics on the 9 period, looking back the last 9 periods, 14 period, 60 period, 60 period. So in that last 14 periods, where that price is closing in relation to the other periods. Do you know what I'm saying? Sorry if I'm getting a little crazy there. So now that we have determined that we want to use these divergences, here are the rules of the divergence. Divergence rule. Stage 1. Stochastics have to be, this is on a buy side divergence. Stage 1. When the price makes a low, the stochastics are at a low. Under 20. Then the low should bounce and bring the stochastics back up above 20. Now the farther, we'd like to see it above 30, 40, 50, around that range. I don't usually tend to look for a full rotation. Usually goes up a little bit higher than the previous high, makes a little, it makes a higher high. And then it comes back down quickly. The price turns over and comes down. And the stochastics come down, but they don't come down as low as the previous low. So that's stage 2. The same time stochastics hold above the 20 line and then turn up, putting in a higher low on the stochastic. All right, well, so we did all that. That'll happen. Then there's optional things that we want to pay attention to. The 5-minute time frame and the 60-minute stochastic should be moving in the direction of your trade. More of the 5 minutes. 60 minutes is really a big time frame, so I wouldn't go so much into that. The lower low should be capped with a reversal candle. So that second stage of a divergence, the bigger the candle, the better the candle, the better the setup. If we go back here, it's a great example. All these examples are going to be the same because it works so well. Here's a reversal candle. This is what we call a piercing pattern, or at least a kind of a hammer. We took out the lows. I don't even care what the Japanese name is. We took out the lows and we closed towards the highs. That's the important part. And the stochastics held above the 20 line and we took out the lows. So I'm not looking for an individual hammer or a piercing pattern or an engulfing pattern. All right, our outside day, I'm looking for a flush and a close higher into the previous candle, typically more than 50% into the previous body. All right, you'll be able to recognize these over time. You know, the bigger the tail, the better the play there. So that's a great example there. Breaking news: China sues U.S. claiming it shouldn't be blocked from selling to federal government. These guys are selling everyone. Oh. Video here. Next one here is the sell side divergence. Well, this is actually stage 1 of the divergence should be have stochastics under 20. Stage 2 have the pretty quick move back down. I guess this is another version of that I did. This is showing a double bottom divergence. And you see the steepness of the divergence here on this one? So basically a lower low or a same double bottom is very important. As long as you have the relationship between the stochastics and the price, it gives you that clear divergence. It is clearly seen here, and that's your key. So great example there. Here, that's a sell side divergence here. Same thing, just the opposite. We saw a few of those today. You know, I'm going to go through and show you the divergence today. It's textbook. What happened? I went back to the wrong thing here. There we go. Stage 1 high with the higher on the stochastics, and then a little pullback, and then the market here kind of pushes higher and takes out the highs, but the stochastics here do not make it back above that 80 level. And from that point on, we start to see weakness until we get down here. Not a big trade, but relative to the time frame, it's perfect, and it's going to give you an edge. Not all these are meant to be taken. If you have a very aggressive trade to the upside, you might get a divergence here, and you might get a little pullback, but you're still going to get the upside move. So you have to take these things off, and you have to understand what side of what team you're playing on. You know, if you're long in a downward trending market, then you have to take off your positions faster, and the opposite holds true too. If you guys have any questions in the room, please feel free to ask. I have no problem answering any questions. All right, so here's a special thing. I guess this is good to go over. You know, I think breaking down everything, you have to break down how you're going to allocate your trades, what positions you're going to take, how much you're going to take into each position. You know, eventually I think I'll break it down even further, that the wedge pattern divergence, I was talking about this before, this type of divergence, let me show you. This type of divergence over here is what's the word I'm looking for? Qualifies for multiple contract trade. So normally if you're saying you're the beginner trader and maybe trading 2 contracts on the divergences, this would be one that you have to step up to. You know, double down. This is you're at the casino and you get the dealer gets delta 5 and you have an ace, or I don't know. I'm not the best. You know I'm going here. Your odds are the best on this setup, so you might as well take advantage of those odds. The same thing. When you see a divergence here, you better get the hell out of Dodge. Easy enough to identify them, harder to put your finger on the trigger and pull it. But this is where you step up. Now, going back over here, this is just kind of a way that I have, and I have this available. This is actually available on the School of Stock as a download. And again, it's a spreadsheet which tells you how many shares you should, or how many contracts you should get into with a certain amount of money. I actually have a working one where you can put in the amount of money you have, and it'll break it down for you. All right, so there's always been what we call a 2% rule, risk rule. Quote, that's what they say. You want to stay in business, you limit your losses, keep a tight rule on how much you're going to risk. 2% of your account on each trade. That seems very light. All right, it seems very light. I usually take a little bit more. I go up to 3%, 4%. Really, with this setup, I would even take a bigger percentage. But we're going to just use a basic outline and benchmark, and we're going to talk about that 2% or 2.5%, just to kind of give you a base to work off of, and then you could adjust it due to yourself. But it works good. Sergeant Pepper has a question of all the stochastic, fast, slow, full. Which are your opinion the best and your favorite? I tried them all. I used to like the 14.3. I have a lot of George Lane's notes, and I got into the 14.3 because he was using 14.3, and then I found a section of his notes where he started going back to the 9.3, and he was like, you know what? It made a lot of sense that if I use them both, the 9.3 and 14.3, if they both set up, then I would say that's a qualified. That's going to work great. And then here's a 14.3, here's a 9.3 above us. Both of them work out as a divergence right here, and then we have the best move possible. Some cases you could see a better divergence on one than the other, but I think the 9.3 is going to give you more opportunities, but the 14.3 will give you more overall success, or less opportunities but more of consistency. And I don't have the backup data to prove that, but I think I did a few tests on it once using the back testing system on the 14.3 and the 9.3, and I think I wasn't getting enough alerts on the 14.3, so I switched to the 9.3. I was getting better alerts, getting more alerts, and it seemed to be working better. But both of them work good, the 14.3 and the 9.3. That's the 14.3, this is the 9.3. Both of them are fast. Now, the fast stochastics was the original stochastics, and then they developed the slow stochastics, which was actually the fast stochastics with the moving average already applied to the percentage K line, if that makes sense. So the fast stochastic is a regular 14.3. The 3 represented a 3 moving average applied to the 14. The slow stochastics already has the 3 applied to the 14. Then it gives you another parameter that you could add to it, but it's already added. And that's already automatically slowed down. The full stochastics has an extra parameter. And, I studied it for a while, and I said, Jesus, why are they complicating things? And I just kind of dropped it, and I don't look at the full as much. And then probably Scarlett, my daughter. It's a little time, 8 years. What is this? I don't even know. 2011. I started working with the longer period stochastics, and I came up with it. I was using the full stochastics on the 60-10-10, and I found that the relation when I was starting to build that tradeometer, I was starting to build everything. I found that the 60-10-10 just worked well, and I don't know if it was a mistake. I just had the 10s in there. What I would do is I would adjust it until everything lined up, and it was just a matter of trial and error. So I've always used the full on the 60-10-10 because it worked the best for me. And, that's the only reason I used the 60-10. The other ones I used are the fast. So I'm using the fast on the 9.3, fast on the 14.3, the S&P here. Oh, actually, I don't see it on here. Sometimes I have 3. I have the 44. Oh, there's the 9 up here, 14. This is the 44. Let me double check what I have that on. I think that's a full also. Hold on. No, it's a fast 44, and the full is 40-10-1. That's 10-1. Which I don't even think you need to put the 1 in there. I think I just kept it there because it worked. I didn't want to mess it up, and I just left it as a full. I don't think you even have to apply that 1 to it on that. So I have the fast 9.3, the fast 14.3, the fast 44. The 44 I don't use that much, but I do see some divergences on there at times, and it really works well. So I do keep, it's here, and it, again, just by habit, I've been using it. And definitely we liked using that that 60-10 as our triple stochastic flag setup. I only use that for overall trends because it really matches up with a 5-minute cash. It matches up with any 5-minute time frame if you do the calculation. The ratio, if you do the ratio on that time frame. Oh, I didn't even show it to you. I'm sorry. I'm not even. I should have been showing you this. That's the problem with doing it this way. So yeah, so I was just showing you this before the indicators. It was 9.314.3. I checked it out. All right, let's move on. So I get messed up here. And then inputs 9.93. No, 9.9 on the slow. No, 14.3 and 9.3 on the fast. Period. And don't use your percentage K line. Percentage K line, if I use my percentage K line, you see all this chop going on, the crossover. It's very distracting. Use your slowed average. The percentage D line is at 14.3, but only showing it applied with the moving average. So I'm not showing the 14 plane, the 14.3, it's just the moving average. I don't use, if I cross over, you can see that underlying line. You see how spiky that is and stuff. I have no need for that. No need for any distraction. I want to see a clean divergence on the percentage D line. So that's why I have those just like that. So again, now we'll get back to, you know what? Let me pause this for a second. So back to this just little worksheet here to kind of determine, especially if you're a newer trader, to kind of get you on a, what I always like to say is open up a practice account, whatever broker you prefer. Start off with a certain amount of money that you're going to start off with in real life, but start off on that on the sim account. Apply the method. And apply the method using the techniques here with this next, when you see this, when you see the positioning for the DTR, the divergence strategy, how many, what's your position size? So in this case, everything is defined for you. If your account size is 7,000, if your account size is 10,000, if your account size is 2,500, each one of those account sizes dealing with the margin. Now, this is going to be a little different. So actually, I have to, I'm actually going to fix this because I'll be using the NinjaTrader platform. This is usually using interactive brokers or a similar broker, which has a very large margin for ES trades, but the interactive broker is going to have a $500 margin for the ES trades per contract, which is going to adjust all these. But all we're going to do is just input that, and everything will work out, and you can tell you how many contracts you should trade to be under your risk tolerance level, your acceptable risk. All right, so max risk 250 to 3, and it'll basically tell you what your percentage size is, what the risk is. Here's a risk level of, if you had 2 contracts, you're talking about 1.5 points. 1.5 points if you had a contract, of an account size of 7,500. But again, this is not going to be 100% correct. But the good thing about this, I have the worksheet. It'll be in the forum when I post this, and you can apply your own numbers to it. So this is just an example using the IB. I just didn't update it to the cheaper margins, and the cheaper margins let you go better. So we're talking 3, 4, 5 contracts, which is better. Much better. So this is kind of comes here. This is the one I actually fixed. So I did fix it. This is account size $5,000. This is what I'm going to be opening up the NinjaTrader one with, and we're going to be tracking everything on it. So the NinjaTrader is going to be an account. We're going to use this whole method, and then we're going to apply the account to it, and we're just going to have it track on a thing. So it's margin 500, 5,000. So each of the trades here, to get maybe to kind of hold a 3% risk. If I go to, what do I want to do here? What my percentage here? 3% risk. I sometimes go to 4%. But we're talking average of 2 contracts, the trade at that level, with an account size of 5,000. And it talks about what kind of risk you want to put in. Now, this is kind of standard, but it really depends on our setup, on the divergence setup. Our divergence setup could give us a tighter risk. It might give us a little bit bigger. I'm more apt to take that divergence low and put a stop underneath that. Even if we catch that divergence late and it may be 3 or 4 points, I'd still rather take that divergence low risk. But this is just a outline for you. You know, it's something that's kind of a nice outline to kind of, again, put you in a position where you're not straying. All right, and this could go all the way up. You know, this is going to go all the way up, and we could adjust this. I think we're going to put the max up here to 3. I'll change the max to 3, and I'll save it on there. All right, but this is basically, you can save it, replay it. You can print this out. This is basically a pretty good thing. So you want to apply this and take these trades and let your account grow. As your account grows, you're going to get a different, you know, you're going to be able to hold more and more contracts on each of these trades, and you're going to hence make more and more money. So that's going to be that's going to be a golden thing. So start off small, build up. When your account builds up, apply the strategy. Take as many shares as it allows you to stay within that risk tolerance, and just trade the setups. I mean, we're going to be doing it all together, so it'll be easy enough. All right, so that's what this is going to be used for. So you're going to have that. Kind of go over the divergence again. I mean, that's the most important thing is divergence setup. I think I went into this. I'm going to organize this. This is why I'm doing a test run with you guys. Average whiteboard, yeah, you put 15,000 because their margin is so high, and probably overnight maintenance and stuff. It's probably like $4,000 a contract. One contract, you must, I don't know, 15,000 seems like a lot. I mean, not only getting one contract. Anyway, I don't know. So again, we talk about that. You should know that by now. Here's some live advantage, again, different time frames. And remember, I'll be talking about this to a lot of new members, a lot of newer traders, introducing them to these setups. So I'm going to kind of be basic on this, but just the important thing is to see it and start to see these setups. Here's a little divergence here, beautiful sell side divergence there. Some cases you can actually double bottom divergence there. You start to see them. You see them. Here's a nice divergence. These are really just strong, nice divergences, like everything else. La-di-da, you could ask RPM. I think RPM was using AMP for a while. I'm not 100% sure on that. So, I don't know. Sell divergence, 1 minute time frame. Next one. Same thing here. Look at that divergence. Look at the move. Over and over and over again. This is your opportunity. I mean, this is absolutely a fantastic opportunity to establish this. And again, if you don't think you could find this stuff, that's what we're here for. You know, we're all in this together. And it's only going to get bigger. It's only going to get better because it's going to, now we have so many tools to use. I think people start to realize that, and when I start to see a lot more participation in the chat rooms when people see these divergences and they take it. Some really good traders have joined on, and they make the point of calling out the trades and saying, "Hey, I'm taking the bot trade," and you see these things move. We just had a bot trade before, but again, they're easy enough to spot. Just have to spot. I'll spot them for you. I'm spotting them. Again, it's dark here. These are what you typically see on my chart. I'm going to go over some charting stuff. All these lines and stuff. Here's an example of that full stochastic. Remember I said I used to use the 60-10-10. There's the 60-10-10. I think I put in the 60-10-1 at one point. But anyway, here's the full stochastics 44, the fast 14.3. I don't even see the 9.3 on here, which is will be another one. This is a little older chart. On this chart, you're seeing a lot of lines. All right, the stochastics are easy enough to recognize. Volume is always important. The lows, the highs, the previous highs, the major pivots. The circles and squares are representative of when I mark out on the chart if there's any Rambot trades. So circles represent buy signals, squares represent short signals. All right, during the day. The other lines here just represent me live analysis of the market. Look at this 44 rotation up here with this flag right here. That's what we're looking for, combinations. And then a breakdown, lower trend line bounce, and things start to really work out really well. Let's go on to the next one. Your longer term, should have put an apostrophe. All right, some of the spelling errors I have to correct. No, that's okay. Well, I just want to make sure I don't have any. Again, multiple time frames. This is on the daily and weekly charts. The divergences are going to give you huge moves. So this is even more important for someone out there who wants to trade but they don't have that much time to trade. I would trade daily divergences. It's time to get in on a certain good stock. Wait for the setup. I set them up. We point them out. So, I mean, that's another good reason to be part of the HPS, at least have this delivered to you. Even if you're not trading every day, it's not a waste, because when you get a good setup like this, you want to know about it because it could be a longer term trade. You don't have to worry about the chop of the overnight. You know this is probably going to end up working out. You're probably going to end up working out for the next couple of weeks. You don't have to be in front of it. You have a nice divergence like that. The odds are you're going to get a nice move here. Just easy enough to put a stop under it. You don't have to watch it. You get a nice divergence on a quality name. You go long and you shut the computer. You don't have to be there like we're there every single day. So it's important to recognize that these are the best things. Same thing with the 60-minute time frame. Little better, little shorter time frame, but a longer one. Gives you multiple day runs, usually 2 to 3 day runs we like to see off of a 60. So if we have a 60-minute divergence like here, you'll get a nice bigger pop. This is a quad stochastic wedge pattern divergence. I mean, everything's ripping here higher. So again, it's just a matter of being on the time in front of the screen. The ATM machine, you have to put the time in. As a trader, there's something about traders too. Traders have, they're not organized. I'm talking about myself. You're working for yourself. You're trying to do. It's so hard because you have no oversight committee watching you. You're responsible for your own self. You want to go take a nap or slack off or have a drink or to have a smoke, and you're not paying attention. You have your own self to blame. Be successful in this stuff. You have to be razor sharp in your approach, in your discipline, and I stress that so much. I stress it so much it becomes tiring. But that's it. The setups are there. Every setup I show you works. It's a matter of being there and being dedicated to take it and being set up properly to take it and applying the rules. Also understanding not every setup is going to work and being able to see the setups that counteract that, like the bear flag that comes into a divergence or a bearish divergence that turns into a triple stochastic bull flag, and know when to get out. There's certain things that take time. You're going to learn over time that we're able to identify, but you really don't have to. I mean, we're working together at this. I'm not trying to say that you can do this on your own, but it's probably not the best thing. You missed too many setups here. Here is the 60-minute sell side divergence. I don't know what I'm seeing there. Oh, probably over here. Look at this beautiful 60-minute divergence. Everyone. And these are all oversold stochastics. I mean, we know where these things. Let's take a look at that apple in a second. Daily divergences, again, stressing how important they are. You get much bigger moves. When you have a daily setup, stochastic divergence, and the underlying trend line, which is so exact, It is a must go to trade. This is just this is almost like a wedge pattern. The wedge pattern is a little bit stronger but they both are qualified in the downward channels. They both are these downward trending things, and they could both be qualified as a downward channel. And this could actually be a wedge pattern too. I mean, I didn't tighten that up. But when you have a lower trend line and a steep stochastic like that, again, impossible not to realize we're onto something. Now, how do you take these trades? Next segment of the video here, and kind of the process is how do you trade those? I could show you great divergences in the futures or on the S&P. Well, you could apply that across the market. If the market is trending together and you have Amazon moving up, the market's moving up and the market's moving down, Amazon's moving down. Or you have a beautiful move in like today we had a beautiful move in AKAM, Alchemy. Yet the market was selling off. But when we identify a place for the market to break out because there was a divergence, Alchemy will take off to new highs at that point. So in any situation, this is back over here when we identified this beautiful wedge pattern, divergence. You go back to a lot of these stocks that were maybe consolidating at the highs and stuff. This will be the area where they break out. So whenever you see a good setup on the ES or the NASDAQ, whatever trading vehicle you're looking at, the peer group or peer trade, peer companies or companies that don't trade relative to the setups, the S&P 500 companies versus oil and gas companies on an oil and gas setup. You could trade those with these divergences, but how would you do that? So you have the SPY. All right, you have the SPY. So let's say we're identifying these setups on the S&P, and you're not a futures trader. So I want to trade these using the SPY. Well, you can. You're still going to get that move. Here's your divergence. Here's your move. Maybe you got a 34-cent move in the SPY. But who's spending $234 a share to make 34 cents? I mean, you could do that, but it seems like an obvious way of doing it. There's a better way of doing it. So that's why I'm just kind of pointing this out in the comparison. We kind of compare these. So that's how you could do the 5-minute SPY. The SPX 5-minute divergence gave us 3 points. All right, so that gave us 3 points. 1-minute divergence on the SPX. Well, you have some multiple ones here. You could see the relationship on those. But I'm gonna get a little tighter on this. 1-minute divergence on the SPY. Same thing. You're getting the moves. You can do the calculations. 136.08, 136.05 to 136.20. It looks like a nice move, but it's only a 20-cent move. God, or 15-cent move. It's crap. Wouldn't mess with that. I mean, it's great, but it's crap. Now we're going to get back to that in a second, but I want to also talk about adding indicators. This shit needs to go a little bit. I need to fix this. So this one needs to go up a little higher. A little bit higher in the thing. But adding other indicators is the important part. The divergence is great, but having that underlying trend line or rising trend lines adds so much to it. When you have all that combined, as you can see, divergence, lower trend line, divergence. This one is not a really rising trend line until this divergence came into play, so it's kind of cheating. But I put it in here for this other one. And then you have a nice divergence here. I mean, the divergence really, actually, that probably looks like a nice channel. Oh, here it is. There it is, right there. That was like too many lines popped up there. All right, so remember when we went all the way back and we were talking about the different other indicators that line up with a divergence or line up with your high probability setups? Reversal candles were one of the things. So these are some of the reversal candles you should be looking for. And again, this is not a reversal candle course. I'm just going to go over a look and feel of them. These are reversal candles. Reversal candles. Hammers and shooting stars. These are basically, you're going to see the bullish and bearish counterparts of these candles. And the definition of how you want to see them. You want to take out the lows, sometimes depending on your time frame, period. Remember, we talk periods instead of days, because we might be talking about a 5-minute time frame, maybe a 1-minute time frame. But the bigger the pullback, the bigger the candle, and the way it closes, it all means something. And that comes with practice, but the candle should stand out. And if that candle stands out at the same place that the trend line stands out, and that stochastic is given a divergence with that dip down, and that's a reversal, all that adds together, that is a must-take trade. So that's I call it the sixth indicator. It's a special indicator. Bullish engulfing patterns. Same thing. Takes out the lows, closes above the previous day's body, closes higher above that. All right, gap down, closes higher. There it is right there. Everything all identified for you. The follow through, where you should put your stops. All right, good stuff there. Piercing pattern, same thing. The important thing is the gap down or the move down. I'm going to talk about the gap as much as the move down. But then the reversal and closing above the 50% mark of the previous body. Piercing pattern, the opposite is the dark cloud cover. Same thing, just the opposite. Here's what they look like. Put a lot of work into this, as you can see. It's because I know it works. 5-minute rotation in favor of the 1-minute setup. What do I have here? 5-minute setup. All right, so you had the 5-minute rotation and then move up here. Here's the SPY. Here's the SPY options. So the SPY gives you a 0.25% move. The options, SPY options, this is go back a little. I have to adjust these things. SPY option gives you a 30% move. 30% move, versus the 0.25 move. And again, if you're buying, you're spending $236 a share. Just to say you got in here at 236, it went to 236.20, went to 236.70, 50-cent move. 50-cent move, but you're paying $236 versus here, same level. You got in, just say you got into that on that thing, you're going in at 70, whatever price that is, 80 something cents. You're getting out at $1.10 or whatever, but you're talking about a 30% move. Now, all things equal, this is much better, but all things are not equal. Your exits might be hampered by liquidity. You have to get the right, the timing on this. Liquidity is important, having enough volume, the spread. But and the option, when you talk about these SPY options, you shouldn't have a problem. The spreads are very tight. Very, very tight, and usually a penny. So you shouldn't have a problem with that. Let's go back here. Let's give an example how this looks. So how do you get the biggest bang for your buck? How to use the tradeometer. I put a little plug in for the tradeometer. Focus on E-mini futures, SPY options, and SPY shares, comparing all three of them together. An example, we're using the SPX of the S&P 500 as our main underlying trading index. We'll break that equal comparison across each of them at the same price. Or we can trade when we apply our divergence method to the S&P 500 S&P cash chart. Let's look at each of the trading vehicles and see where they are in comparison to the SPX. All right, so again, I did a couple of these seminars. So there's let me go back here a little. All right. These are what we could be trading. We could be trading the ES mini futures. We could be trading the SPY, which is the S&P or the spiders. It's the ETF. That's our benchmark. We have SPY options, weekly and monthly options we could be trading, or SPY leveraged ETFs. leveraged ETFs represent the leveraged, like the SPXL, SPU, SSO, UPRO, bull and bear ones. I have the bulls here, but there's also the bear side. And I'm not taking favorites, but I'm just conserving on my workload here. Just do the opposite. So these are different ways we could trade any of these divergences. These are different things you could use. And not to mention that you could trade individual stocks against them too, as long as they're moving. The market's about to take off on a beautiful downward wedge pattern divergence. You're going to get a nice move. Sure, you could get into Apple. Apple will probably move with that. Who knows what else will move? But something will move. Just have to find it. This is already like an hour long. They only have me on here for about a half an hour. 40 minutes maybe. I'm going to be going over. So at the time here when I was doing this experiment, this comparison, the S&P index was at 2188. Don't worry about where it is now, 600 points higher. The ES, it was 2188 and a quarter. The SPY shares were at 219.30, and weekly SPY in the money calls close to the in the money was 35 cents. I don't know how many days that was left on that to give you the truth. So I was saying, all right, with the $5,000, what can you get? Discount pro shop around, pay as low as $500. The Apex Futures has the low initial margin. So does NinjaTrader. Or you can pay $3,600 Interactive Brokers, or just be realistic. So I'm just being realistic. I'm just saying 2 contracts. We're going to be comparing everything with 2 contracts because that's, I think, a good way of testing things. SPY shares, if you had $5,000, you could pretty much get 22 shares. 22 shares. So just to kind of put it in perspective. And then you have the SPY options, weekly options, usually expire in 1 to 2 days until expire. 35-cent contract, $35 times 35 cents, right? 30 times 100. So I think we were just doing 20 contracts. We weren't getting carried away. We could have got a lot more, but I was just being very conservative. I'm saying 100 contracts. That's a lot. Well, or 20 contracts. That was a lot for a trade on this, on a short-term divergence. So I said, all right, let's just be a little. You're only be risking $700. $700 versus the $5,000 you're spending on 22 contracts, or the potential $1,000 you could be doing on NinjaTrader or Apex, or you could be anyway. So here you have your weekly options on the SPY. So with your SPY making that 0.25% move, the weekly options made that 30% move, which is 64 cents, or is that 54? 54 cents from the divergence low to the top, and it was a 27-cent move on the options. So that's why you're getting that big return there. You can see that, right? Everyone could see that. So this kind of showing you if you have a really, really, really great setup, $700 and 20 contracts, 27. All right, let's see what that gave us. So again, SPY shares, 22 shares, ES contract, 2 contracts, SPY options, $700, 20 contracts. You could get a lot more for $5,000 on the SPY options. Just remember that. 5,000 in SPY options would be about 142 contracts. So E-mini futures at the time of the signal or 124 moved 8 ticks or 2 points in for a 7.14% move on the ES futures, or a profit of, again, 2 points, $200. 2 points, 2 contracts, 1 point, $50 a point. So $200. SPY weekly options at the time of this signal, again, I just do the calculation, moved 10 cents to 28 for a 28% move, netting us a profit of $200. And then remember, we're only risking 700. So there's a huge percentage gain there. And the SPY at the time of the signal moved 33 cents for 50.15% move, netting us a profit of $7.26. So I think where we're leading here. Tools of the trade. You want to really effectively take advantage of these setups, we have some tools to help you. Now we have a new trading bot that really identifies the divergences, and really in a great way. That's going to actually take over for the RAM bot. The tradeometer is deadly. It's a sniper when it's in the groove. It can't be stopped. And look at this. This is just an example. The real-time alerts. You could get these signals sent to you. You're going to eventually have the bot signals sent to you too. So if you remember Day Trading Radio, you get all these signals. When you have an alert, you get it sent right to your text message and your. So make sure you have that set up. It's on your dashboard. The dashboard. I should put the dashboard up there. Maybe I did. I don't know. Did I put the dashboard? No. Here's another example of the tradeometer. Just great levels. So this is the method you should apply. Trade the demo, double your account, fund a new account, start live, and repeat. Start with 2,500, go live at 5,000. Start at 5,000, go live at 10,000. There's a learning curve, but it's not that bad when you're being shown the positions. You have to develop your own stuff here. Day Trading Radio. So what do I need to put on here? This is about it on this. Bonus. I was going to do a triple stochastic flag setup. Oh yeah. So I did some bonus stuff. I was working on it. Boy. So the flag setups are really good too. I think that's it. All right, that's it. And we're back to the bot now. All right. Well, that's the basic. I got to work on it a little bit more, but that's the gist of the presentation for the trade show in a relaxed way with you here at 9 o'clock and change. But I think it's always great information, always good, and we'll put that in the members forum. Let me log off of here right now.